What's up, my G's? Let's see if the stream is playing. Yeah, everything seems to work fine. So today I'm studying a little bit about breakaway gaps. And the reason is that I'm in this Discord community uh, where I discuss my trades and discuss about trading with other people. And what I have figured out is that, or what I figured out this morning is that I did my analysis, and some people were talking that some gap that I was looking to inverse was invalid because it's a breakaway gap, and I wasn't really sure what that meant. You know what I'm saying? I thought that breakaway gap is just a fair value gap that never gets tagged in, but it's just like I don't really know how to utilize that uh, at the end of the day. So I'm just trying to investigate breakaway gaps a little bit in YouTube, and I thought that I would live stream this as a ICT study session. So let's move. We got my inner circle notebook where I usually take all my notes. So let's just go. What do I have here? Here are all the ICT series that I want to take notes on. Then we got individual ICT lectures, such as live streams and some individual things. Then we got third-party lecture navigation. And this is where I usually collect all these kind of third-party notes, and this is very unarranged right now. I started to do it like this, so we've got like market maker models. Then this is like one topic, and I open that, and then I have multiple videos about market maker models from different YouTubers here. So just quickly take a look at this. Like I don't know what Notion is so laggy right now. Anyhow, FAG. This is our Do I have like too much content in my Notion page because it takes like ages to load the page? And I mean, there is quite a lot. I don't know if it's my internet. Oh, OBS disconnected. Let's see. Yeah, the movement seems just fine in my end. So, I like to have like a database here. Database view, new table. Maybe I shouldn't be taking the notes on Notion, guys. It just lags like a motherfucker. Google Drive it is. Folders. My Google Drive storage is almost filled, so that's another nice thing. It would be €2 a month to get 100 GB. So yeah, we got a Google Drive document. So let's just watch this REO video and maybe like this one. I don't know what that OTE trader. Don't know who that is, but actually looking at this, I think ICT advanced gap theory. That's ICT's interpretation. But I'm studying right now ICT 2023 mentorship, so I don't wanna watch that. No.
A fair value gap does not always get traded back into. This is called a breakaway gap. Now this could lead to you missing trading opportunities. Now luckily, my trading skills are a lot better than my awful handwriting. So today I want to go over exactly how you can use breakaway gaps to your advantage. Now we are going to go over two different scenarios where breakaway gaps happen. Before we reach a certain drawn liquidity and after we reach a certain drawn liquidity. So the first step is and after.
So
gaps happen. Now we are going to go over two different scenarios where breakaway gaps happen. Before we reach a certain drawn liquidity and after we reach a certain drawn liquidity. So the first step is, all right, what is a drawn liquidity? A drawn liquidity is again a level where we expect price to trade towards. More specifically, it is a PD rate where we expect price to trade towards. So what is a PD rate? Well, the PD rates that I use are the following. It's a mitigation block, it's a breaker block, it's an order block, fair value gap, swing high, swing low, and as well previous candle high, previous candle low. Might seem like a lot, but it is quite simple. And let me explain why. Now, most of the time, your drawn liquidity is going to be a swing high or a swing low. Again, swing high, swing low, those 3 candle patterns, right, that you see on the screen right here. When we have a chart like this, for example, and we are currently on the weekly time frame, which is quite important to note, then we see that we have been moving higher aggressively right there, also seen by this fair value gap right there. Now, first thing I want to do is I want to see, okay, if we are moving aggressively higher, what are we moving aggressively higher towards? Well, we have a swing high that is sitting right there. And just above that, we have this swing high as well. So that line on my chart is where I'm expecting price to head towards next. Simply because price has been going higher right there, shown by the last 2 extremely bullish candles, and then marking out the premium arrays which we might want to head towards right there. Because price is always heading towards a certain PD rate. It's just our job to find out towards which PD rate are we actually heading. Now, I mentioned I'm currently looking at the weekly time frame, because I first want to go over how we can use breakaway gaps in higher time frame narrative scenario. And then after, I also want to look how you can use it for your entries. Now, narrative, what actually is that? Narrative is, if we are indeed going higher right here, then where are we going higher from? A lot of people would see this weekly fair value gap right here and would expect a retracement into that fair value gap to then continue higher off of that. And time frame relativity theory is simply the higher the time frame, the stronger the time frame. So we want the daily time frame, for example, to be in context of the weekly. So as a general rule of thumb, if we have a daily fair value gap above a weekly fair value gap, it's not going to be as strong. But when we have a breakaway gap, this is actually not the case, and we do want to go down a time frame. So how do we know of the time frame relativity theory? Relativity theory is simply the higher the time frame, the stronger the time frame. So we want the daily time frame, for example, to be in context of the weekly. So as a general rule of thumb, if we have a daily fair value gap above a weekly fair value gap, it's not going to be as strong. But when we have a breakaway gap, this is actually not the case, and we do want to go down a time frame. So how do we know that this fair value gap is not going to have a retracement into it before we actually reach this draw on liquidity? Right there. Well, that is by understanding a fair value gap at a basic level. We have 3 candles whenever we create a fair value gap. The first candle can do whatever it wants to. It's not super relevant what it does. Can be an expansion, can be a consolidation, doesn't really. Whenever we create a fair value gap, the value gap at a basic level. We have 3 candles whenever we create a fair value gap. The first candle can do whatever it wants to. It's not super relevant what it does. Can be an expansion, can be a consolidation, doesn't really matter. The second candle is always going to be an expansion phase candle, meaning the body is closing clearly above the first candle high if we create a bullish fair value gap. Vice versa when we create a bearish fair value gap. Then the third candle will help us in determining if we do create a breakaway gap or if it's actually a fair value gap that we can trade back into immediately to then continue higher. If the third candle is an expansion phase candle, just like the second candle, like we see right here in this example, and it's not a consolidation where we set up perfectly with the third candle to trade back into that fair value gap to then continue higher. Set up perfect here in this example, and it's not a consolidation where we set up perfectly with the third candle to trade back into that fair value gap to then continue higher, then the probabilities are that it is going to be a breakaway gap instead. Now, before reaching a draw liquidity, there's generally two ways we can go about spotting a breakaway gap. There's an easy way and a more advanced way. The easy way is simply taking the second candle right there, and if we are creating a bullish fair value gap, we want to mark out the second candle high right there, so the wick. And when we close above the that second candle high right there with the third candle, generally speaking, that is going to be a breakaway gap. But this is not always the case. If you only use the easy way, you are probably going to assume, well, this right here is a fair value gap, so we should trade back into it. But understanding candle science right here helps you in understanding that that third candle is actually already an expansion continuing higher. Why? Because it's a bullish up candle. Relatively seen to the overall wicks, we have quite small wicks on both ends, and we are already expanding higher, continuing higher. Why? Because it's a bullish up candle. Relatively seen helps you in understanding that that third candle is actually already an expansion continuing higher. Why? Because it's a bullish up candle. Relatively seen to the overall wicks, we have quite small wicks on both ends, and we are already expanding higher as well. So on the lower time frame, we already have fair value gaps going higher as well. Another example is this right here, is where we again create a fair value gap sitting right there. We do not close above the second candle high right there. Well, we do not even trade above it in the first place, but still at the bottom, we have a long wick right there. That long wick at the bottom indicates that we have fair value gaps already pointing higher. So we might not want to trade back into that fair value gap.
Yeah, here he says that this could become a breakaway gap, but I don't really see it. Like if I was trading this, I would, let's say this is a daily chart, I would want to go higher on after some of this is being tagged because the daily candle looks like that. So I don't know, agree 100% with this, but
which will then in turn become a breakaway gap. The more advanced way of looking at those breakaway gaps are usually as well sneaky breakaway gaps. Again, with experience, you will get better at noticing those sneaky breakaway gaps. If you are struggling at first, then just use the easy rule. If we close above a second candle high, like this for example, then this right here becomes a breakaway gap. So we have our drawn liquidity. We have our breakaway gap right there, which is again simply a fair value gap that we are not going to trade back into before we reach the.
okay, I need to backtest this a little bit, but yeah, if that is a breakaway gap, then we get a small one here. If I expect market to retrace into that small one, I would also expect it to sweep that one before moving higher because they are in so close proximity to each other.
Gap. So we have our drawn liquidity. We have our breakaway gap right there, which is again simply a fair value gap that we are not going to trade back into before we reach the drawn liquidity. Now right here, the next step we then want to take is once we have identified a potential breakaway gap.
Drawn liquidity, breakaway gap, drop down on one time frame to look for FEG. We can trade off of. Okay. We are not expecting markets to trade into a breakaway gap until market until it meets the drawn liquidity and sweeps it.
We want to go down a singular time frame to find a fair value gap that we can indeed potentially trade back into. So from the weekly, we go down into the daily right here. And on the daily, we see that we do have a potential fair value gap that we can actually, on the daily, we see into. So from the
So in this example was in a weekly time frame when market has created that breakaway gap, and we expect that to not being traded into. You can scale one time frame lower. Then you scale one time frame lower and go to look for a bullish fair gaps that you could go along from.
on the weekly, we go down into the daily right here. And on the daily, we see that we do.
Wait. Like, I don't fully understand this example because this daily, that's this Friday, Monday, Tuesday, Wednesday, Thursday, Friday. Oh yeah, so that's the weekly candle as it is. So the weekly candle is closed, which means there is now breakaway gap, and that's the reason why we would expect this to be traded into, and also this order block to hold. So this is valuable stuff, man. So Oh, sorry. So see that there is a bullish daily FAG above that weekly breakaway. And we can take a long from it. There you go. That's
have a potential fair value gap that we can actually look to trade back into right there. Where eventually, off of this order block that we have right there as well, and the fair value gap, we continue higher off of that, creating new expansion phase candles, new potential fair value gaps, or again, breakaway gaps. Now, every discount rate that we see right here on the daily,
so this would be a new breakaway gap then, if I'm not mistaken.
that fair value gap, that order block right there, even the swing low right there, that's where we expect higher prices off of, instead of expecting a retracement into that weekly fair value gap. Now, whenever we have identified a breakaway gap and we do actually retrace back,
we can take longs from it, or maybe take shorts towards it. Yeah. So yeah,
into a breakaway gap, that's not really a good sign to continue the trend. So for example, right here, if we were to indeed retrace back into the weekly fair value gap, I would not even want to see that, because that's too far of a retracement to make if we are still bullish. So
I mean, he's saying it's too far of a retracement, but what I've learned, it's like it would be totally reasonable, because it would be like a discount and premium and discount, and this is somewhere around 50%. So it's like, okay, it would be totally reasonable to see this, but um, so this is something I definitely need to study. If price comes back down to
I want to see the daily right here getting respected to then continue higher. Again, the daily, so I only want to go down one time frame, not two, only one. Then after the daily sweep and the retracement back into that order block right there, what do we see? We create again a new expansion phase candle right here. Now that expansion phase candle is where we can again see this is a potential breakaway gap. So right now we can indeed go into the 4-hour because we have a daily potential breakaway gap. And again, we still have
hey yo, what the So we can now look for the same thing as prior in 4-hour chart.
Into the 4-hour because we have a daily potential breakaway gap. And again, we still have this draw on liquidity right there. So going into the 4-hour, what do we see? On the 4-hour, we see actually that we already had a retracement right here back into fair value gaps where we can now look to actually continue higher off of. So when we already want to potentially continue higher right here, we can also potentially look for an entry. Now, how do we know this already potentially wants to continue higher right here? It's also seen by the long wicks at the bottom.
Yo, what the so yeah, we're not expecting market to trade down to that massive wick because of the breakaway gap that we identified here in the daily.
Bottom right there. Now you might also say, well, wasn't this right here a potential breakaway gap right there as well? Yes, you are correct in that, but this is something I will go over after we reach the drawn liquidity. When we have these long wicks right here at the bottom, again, indicates we might not want to trade back into this daily fair value gap right there that we saw. So here, if we now go into the 1 hour, what do we see? We have a new breakaway gap going higher right hour. What do we see? We have a new breakaway gap going higher right there. So what do we actually do? Do we just consistently go down time frames to find an actual fair value gap? You don't have to do that. You can also enter off a breakaway gap itself. Meaning, if you want to enter right here on the 1 hour, what could be a potential entry? Well, since we don't expect a retracement into that breakaway gap right there, we can just simply enter based on the third candle. Meaning, we enter when the third candle closes right there. Your stop loss is going to suffer a little bit right there, but at least you will be a part of the move. And if we do not want to retrace, then you will not have a missed opportunity. So what could be a mechanical way to approach that entry pattern? Well, if we create a breakaway gap, enter on the close of the third candle. If we do not create a breakaway gap and it was a fair value gap, for example, then we could just enter off the fair value gap itself. Now, let's say we want to again go into the lower time frame to now go down another time frame to go into the 15 minute. Then on the 15 minute, what do we see? On the 15 minute, we already have fair value gaps right there as well, which we can continue higher from. So those fair value gaps right there can as well be an entry already. And every 15 minutes fair value gap that we get after right here is as well another entry opportunity. Since this was a breakaway gap, we do not expect a retracement back into that breakaway gap right there. Now, again, this fair value gap right here and this fair value gap right there as well have something in common, because both, you could argue, are sneaky breakaway gaps, right? We do not necessarily want to see a retracement back into those, but both have a reason to retrace, which leads me to the next step before we go over after reaching the drawn liquidity. Whenever we have a certain fair value gap, we always want to find a reason for the retracement. So is there a reason? we go over after reaching the drawn liquidity. Whenever we have a certain fair value gap, we always want to find a reason for the retracement. So is there a reason to retrace back into that fair value gap? If there's no reason at all, then it is a breakaway gap indeed. The first reason is, do we have a opposing unmitigated PD raise that we are trading back into? Again, it's a mouthful. Let me explain. Opposing. What does opposing mean? We are expecting higher prices. So we are expecting discount arrays to hold.
Okay.
Since we are expecting discount arrays to hold, opposing unmitigated is a breakaway gap indeed. The first reason is, do we have opposing unmitigated PD raise that we are trading back into? Again, it's a mouthful. Let me explain. Opposing. What does opposing mean? We are expecting higher prices. So we are expecting discount arrays to hold. Since we are expecting discount arrays to hold, opposing PD rays are premium arrays. All right, so what are the PD rays right there? The PD rays, again, is what we stated earlier. They're here on your screen again. And of those PD rays, what does it mean that they are unmitigated? They are unmitigated when they have not been traded back into before. So for example, mitigated when they have.
Yeah. So
have not been traded back into before. So for example, right here, we see this fair value gap, which is an unmitigated opposing PD ray on our path towards the draw on liquidity right there. Those premium arrays on our path gap, which is an so for example, right here, we see this fair value gap, which is an unmitigated opposing PD array on our path towards the draw on liquidity right there. Those premium arrays, we do not necessarily expect them to hold, but they do act as a potential rejection area where we can still continue lower from a little bit to move back into a fair value gap to then continue higher. So that's quite a lot, and I want to simplify that as much as I can. See this from a pushing standpoint. And what do I mean by that? You have a bearish hand which is trying to push price lower. You have a bullish hand which is trying to push price higher. Why is it pushing? PD arrays. So you have premium arrays which are pushing price lower, discount arrays which are pushing price higher. When we are bullish, we have discount arrays pushing price higher consistently. But still, when we are also bullish, we still have premium arrays which we are running into. Those.
So by premium arrays, it just means like a bearish PD arrays.
Premium arrays, again, we're not necessarily expecting those premium arrays to hold, but they can still push price lower a little bit because it's a pushing hand, it's a premium array. So that push lower, which the bearish hand does, can push price back into a fair value gap, which you might assume at first is a breakaway gap. I can understand that that might be quite complicated because it is quite advanced, but understanding this will help your trading and understanding fair value gaps so much. So right here, that is the main reason why we indeed do push lower right there. Then an extra confirmation if we do actually want to retrace back into a fair value gap could simply be watching that third candle. So this third candle, again, we could argue that is a potential breakaway gap right there. But this is also why we go down a singular. Time frame. Because in that third candle, if we do not actually have fair value gaps supporting the ID right here that we do want to continue higher by going down time frame, then that means the intention is not truly there. So we can indeed trade back into the 4-hour fair value gaps to then continue higher off of that. So to continue that process, we again come into those 4-hour fair value gaps, and that's why we can go into the 1 hour right now. And when confirming those 4-hour fair value gaps, going to the 1 hour right here, and then seeing this breakaway gap to then seeing the 15-minute right here, what do we see? Similar, this could have also been a breakaway gap, right? But does it have a reason to retrace right there? Yes, it has a swing high.
Yeah.
High right there, which it could, this could have also been a breakaway gap, right? But does it have a reason to retrace right there? Yes, it has a swing high right there, which it could potentially, if it wants to, sweep. So it has a reason to retrace. Then after everything right here, let's say, to give you one example right here, this could have been a perfectly fine entry as well. Targeting, what I like to do is I like to target a 1 to 2 right there, which is still very small area overall of the overall drawn liquidity, which we are actually targeting right there, which for me is perfectly fine. Again, I do not want to set unrealistic expectations. This right here, a trade like this, is not something I would do, and it's very rare for it actually to play out right there. So a 1 to 2, especially if you're just starting out, perfectly fine. Target a 1 to 2. Then once we continue higher and we keep on continuing higher right here, we see that eventually we reach that draw on liquidity right there. And once we reach that draw on liquidity, we can now talk about breakaway gaps after reaching the draw liquidity. After reaching a draw liquidity, especially a major swing high like that on the weekly, for example, we have more chance to retrace a little bit further. Why is this? This is because we tend to leave behind either an order block, a breaker block, or a mitigation block. So what is a mitigation block? It is simply 3 swing movements. We have one swing movement right there going down, and when we continue higher right there, creates again a new breaker block or mitigation block right there. Now, once we continue lower right here, and we have quite a deep retracement, then we continue higher right there, and we create again a new mitigation block off of the previous mitigation block as well, sitting right there. Of the previous order block actually right there. This gray box right there is an order block. What's the difference? Order block has only consecutive down candles right there before we move higher. Mitigation block has all up candles, down candles, whatever it may be, before we actually continue higher. Why is this important to understand? Because we now understand that this right here, this mitigation block, is a line of defense, meaning it's a support area where we can potentially continue higher from. And that is important to understand because all the fair value gaps underneath that, for example, this fair value gap, but even on the daily time frame right here, fair value gaps that we saw earlier on right there that were breakaway gaps are still breakaway gaps because that mitigation block right there is withholding price from actually reaching these fair value gaps. So the fair value gaps that we see all the way below that mitigation block right there, for example, this fair value gap here as well, they are not fair value gaps where we actually expect a retracement towards before we again continue higher. But they are fair value gaps. For example, an earlier example right here is this fair value gap. We could argue the same, where why did we have a deep retracement right here? Because we actually turned bearish for a little bit right here, where we were failing to continue higher of the order block right there, failing to pay attention to detail, failing to create a new fair value gap right there, creating a bearish fair value gap right there. So we were actually turning bearish. So it's important to note that when we do turn bearish, these breakaway gaps, the earlier breakaway gaps, they can again be targets. And they can again be a potential reason for a retracement like we saw earlier on as well. So to give you another example of that, we can look at this right here. Also a mitigation block right there. That mitigation block is what we can continue lower off of. The fair value gaps in close proximity to those mitigation blocks is what we can trade back into. So those previous breakaway gaps right there, since we have reached a major drawn liquidity right there, we can expect a little bit of a deeper retracement. Now these fair value gaps at the highs right there still remain a breakaway gap because the mitigation block is withholding price from reaching those fair value gaps. It's a resistance area that we are running into. Now, when we do turn bullish, like we see later on, these previous breakaway gaps, they can act as, again, a target right there. Because they are, again, those unmitigated opposing PD arrays. This is how we can understand breakaway gaps and how we want to use them to our advantage to maximize our trade opportunities. To end it right here, I want to say a few important things as well. It is extremely crucial to understand that this does not work 100% of the time. I do not want to set that expectation as well. It's all about probabilities. What we've done here is simply filter out what is the highest probability for price to actually do right there. Next to that, my advice would be, if you want to understand this, watch this video a couple of times. This is extremely advanced material, probably one of the most advanced videos that you'll find on my YouTube right here. So watch it a couple of times and give yourself the time as well to be able to understand it. All right, perfect. Thank you.
Yeah, obviously need to backtest this a little bit, but it makes sense for me. I know all the basics. I know all the main technical shit about fair value gaps, inversions. I just wasn't introduced to the breakaway gaps. So here we go.